impact by transforming lives and building thriving communities. And then our mission statement as an organization: we're changing the nation through the building of thriving communities. We are the leader in funding the building of thriving communities centered in safe, attainable housing. And how we do this is very simple. We have a flywheel. We have internally what we use and call the elite execution system. And this is something that we use internally as an organization to ensure that we are hitting our goals and KPIs and metrics on a day-to-day, week-to-week, month-to-month basis. Then we directly steward resources for wealth creators and their families who seek to make a bigger impact beyond just making a return on their capital. And so we have over 3,000 investor families that are invested with us and currently have about 1.2 billion in equity under management. With that capital, we do several things. We directly finance housing community developers, builders, and operators who want to build elite organizations and thriving communities. We'll talk a little bit more about what those elite organizations look like and what a thriving community, how we define a thriving community. And then we also, as a vertically integrated company, directly acquire, develop, build, and operate thriving communities. Some of our core values here that you can expect when working with us, interacting with us, from really everybody that works at our organization. And Daniel alluded to this, just the growth that we've had as an organization. So I think the statistic that he was speaking to is that we've been on the Inc. 5000 fastest growing companies for 11 years in a row, a host of other awards. And while this is always a great pat on the back for us, more than that, and to me, I think it really just points to the work that we're doing internally and the mission-driven focus of our organization, and that just being acknowledged in the marketplace over time. If you ever, would y'all just like put in the chat or raise your hand if you've ever gotten the K1 late? Anybody? If you've invested in private real estate? Okay, pretty much everybody. So we take a great deal of pride, and as we're in tax season right now, we take a great deal of pride, and our accounting team takes a great deal of pride in getting all of our tax documents out on time. And this is no small feat across multiple funds, 5 billion plus in assets under management and 3,000 plus investors. So our CFO has a little quote there. And he is not exaggerating when he says the team burns the midnight oil in order to get this done, but they are highly accountable and take it very seriously and view this as just a key part of stewarding your and our investor capital very well. Who are our investors? They're high net worth and ultra high net worth individuals in every single state in the US. And then more than 45% of our investors are invested in more than one of our funds. Where do we operate? Where are we located? We have 5 offices currently: Asheville, North Carolina, where I am located. We have a regional office in Orlando. We have our 2 largest offices in Allentown, Pennsylvania, and St. Augustine, Florida, as well as Pensacola, Florida. Our senior leadership team here. And so whenever I am talking about to passive investors about how they should think about investing and how they should kind of go through their due diligence process, who you're investing with is just as important, if not important, as to what you're investing in. And so I could go person by person here on this organizational chart and tell you about their pedigree, their background, and the excellence at which they operate. We don't have time for that, but suffice it to say that Dawn Winner, our CEO and founder, and our senior leadership have really structured our organization to be institutional in nature. So while we're not quite institutional in size, we have an eye towards that. That is our goal, is to be at that level. So every single person on our team has a significant background in their area of expertise. And then just a bit about our investment strategy. So we're, as I said, we're focused on attainable housing communities for attainable housing communities for working families. And what that means to us, and our hard and fast metric that we use when we're determining if we're going to lend, develop, invest preferred equity, or directly own and operate a community, is will that property profitably rent at no more than 30% of the area median income. So to take a market like I'm in Asheville, North Carolina, the area median income is about $58,000 a year. So if we can't profitably rent one of our units for roughly $17,000 a year, about $1,400 a month, then we're just going to pass on that opportunity. And that is the very simple but very hard and fast metric we use to determine if one of our communities is a workforce housing community. Who we invest with: experienced developers, builders, operators, and lenders with proven track records. How we operate: as I mentioned, we can operate as a lender, developer, builder, or operator. We fund projects via our different funds, our banks, correspondent banks and lenders, as well as securitizations. And then our investors are high net worth and ultra high net worth investors who either invest with us directly or via wealth managers or financial advisors. And then our investment thesis. This drives every single thing that we do and every single investment that we make. I touched on the affordable housing, the attainable housing metric of rents being below the 30% area median income. We believe that housing that's affordable, so the local workforce will be in great demand in all market cycles. We're at a really interesting time in the marketplace right now. I think a lot of folks have thought that there was going to be a big crash. We don't really, in many cases, we're not sure what's happening in the market cycle. We're waiting on the Fed to make interest rate decisions. There's a lot of uncertainty at a macroeconomic level, at a kind of a global level. And what we see consistently over time is that housing that is attainable for the large percentage of the American population is always in demand in up and down market cycles. We are very much basis investors. And all that means to us is you can buy the same property at one price and it's a great deal, and at another price and it's a terrible deal. And that informs when we make acquisitions and investments, and also when we don't. And so we've had funds, especially over the last couple of years, as pricing just got a bit zany in our focused asset classes, where we just elected not to make acquisitions because we just knew, based on our conservative criteria, that we were going to be overpaying for those assets, and that was risk that we weren't willing to assume. We believe that housing supply is going to continue to be restricted. You see statistics and news about this all the time, that there's a significant shortage of rental units, and especially affordable rental units. We are a renter nation. We have a higher proportion of people renting than ever before, and the metrics or the fundamentals that drive that do not seem to be changing anytime soon. House prices are at an all-time high. We have rent interest rates that are higher now than they have been over the last several years. And so that drives a number of people, even making well above area median income wages, out of the buying market and into the renting market. And also there's some lifestyle, some demographics, some generational shifts that occur as well, where people aren't as inclined to buy. They want to have more mobility or flexibility or be in different areas, et cetera. We also believe that we're going to see, because of these fundamental trends, that we're going to see, and we are seeing, greater demand for single family rentals within communities that are tailored for them. And then we believe that the Sun Belt is the best place to invest, and that within the Sun Belt, the Southeast is the strongest region. Going on, our focus in these areas is, what we're looking for is job and population growth. Very simply, we want to see both of those numbers trending up. We believe that people are looking for connection and want to be a part of a community. So we have a very community-driven approach to our investments. We think that people want to be a little bit less connected to their phones and spend more time outdoors. We believe that people love dogs. I do. Pretty much everybody I know does as well. And so all of our communities, we allow pets. We believe in the Warren Buffett philosophy to invest when or to be greedy when others are fearful, and fearful when others are greedy. And so we position ourselves in a way that we're able to make investments when others are not. We believe in always investing with significant equity subordinate to us. I'm going to dig more into that later as we dive into the funds specifically. And we anticipate that interest rates will decline over the next 6 to 18 months. And then we also think that the most scalable way to create value right now is to build new housing.
Hey, Andrew, Do you want me
Please.
to stop you periodically in order to ask questions that are coming into the chat, or should we hold them all to the end?
No, stop.
Okay.
I
And
like a pause.
yeah, most speakers do, and it's nice to keep
Yep,
it interactive. And you may answer some of these in the future in your presentation. So feel free just to let us know, hey, if you're going to get to that, we'll get to that in a few minutes. But the
absolutely.
first question was, what percentage of your AUM is from institutional investors?
I'm assuming that question is equity under management, and
Yeah.
the answer is none. And so all of the equity, that 1.2 billion in equity roughly, is all from high net worth and ultra high net worth individuals. So we don't have any large institutions invested with us.
Why do you use the term equity under management rather than assets under management?
Well, so assets under management would be the actual value of the assets in our funds. And so in our housing fund, for example, we have roughly 60 assets at a valuation of the actual assets of about $2.2 billion. So those assets don't come from institutional investors, but the equity to invest in those assets or to acquire those assets do come from investors. And that equity that we have invested into our funds is not from institutions, but it's from individuals.
Excellent. I applaud you there.
Thank you.
A quick one here. Do you invest in mobile home parks?
Yes, we do.
All right.
Mhm.
Uh, what's the typical NOI of your assets? And that might be a question that you have more detail on, so feel free to let us know if that's the case.
Yeah, I'll punt that question because it really varies by fund,
Yeah.
and it's that's a difficult question to answer with 5+ billion in assets across a lot of different funds, and how we actually evaluate income based on whether it's a first position loan, preferred credit, joint venture equity, et cetera. So I can point you, Alex, to some of our reporting. There will be a link at the very end of this presentation. Daniel and I are going to talk a little bit about a couple opportunities. There will be a link to my calendar where you can schedule a time with me just to connect very briefly. And I can actually get you one of the things that I won't dig into a whole lot during this presentation, but one of the things that DLP is really a core principle of ours is transparency and highly detailed reporting to all of our investors and potential investors. So before you ever invest with us, we can give you access to our deal room and our investor portal, and you can go in there at your leisure and review all reporting for all of our funds since inception, including third-party audited financials from a top 10 auditor, Cohn Resnick. And so you can get as detailed and granular as you want on each and every one of our funds. So we'll make that available to you.
Now that we're asking and answering questions, more of them are
Yeah,
rolling
they're
in.
coming in.
So
I love it. I love it.
okay, so Alex has got a great question here that I think
Yeah.
shows insight. What do you think about the Sun Belt being overbuilt in the last couple of years? Does that create pressure on rent growth?
Yeah, it's an excellent question, Alex, and there certainly is markets where there has been overbuilding. We are not in our assets, we're not seeing that. You can see an average economic occupancy in our assets of roughly 92%. And so it's not having an impact on our assets. And I would point back again to the fact that we're very, very focused on attainable rents. I think typically where you've seen overbuilding and a slowing of absorption or leasing up of those assets is in assets that are kind of more in that luxury range, and you have just a smaller percentage of the population that can afford $2,000 or $2,500 a month rents, whatever it is. And so many of those assets that you're referring to in very specific markets were built at the peak at high land values, high labor and material costs, and thus needed to command very high rents in order to justify the development and construction costs. And so while it has impacted certain markets, we're actually seeing most of those being absorbed relatively quickly because of the ongoing growth in the Sun Belt. And as interest rates rose over the last 18 months, development slowed significantly. So the absorption it hasn't had a dramatic impact on, really no impact on our portfolio, and most of those markets, those have been absorbed or are soon to be absorbed.
All right, we do have more questions, but I'm going to let you continue on and keep putting your questions in the chat, everybody.
All right, perfect. You're going to keep us on track where we
Yep.
left off there. Okay.
Yep.
Very good. So as I mentioned, at DLP, we are vertically integrated. So we have highly experienced teams in development and construction, underwriting and acquisitions, credit underwriting, capital markets, legal documentation, asset and property management. So we really are a full service fund manager. And then this is, again, beyond our senior leadership team, when you look into the actual folks that are leading the charge for our lending and preferred credit funds specifically, as well as development and construction, asset and property management, legal, we have an incredible and highly qualified team stewarding your capital and these assets. How we're operating, the actual real estate development process, significant market research, product development, land acquisition, legal. I won't go through the entire list, but we have every single component of the process in-house. And we feel that this is a tremendous value add because it allows us to move, operate, and make acquisitions and investments where a lot of other operators can't because they're dependent on third parties. But then it also allows for us as well to have a tremendous amount of data and expertise in-house. So it significantly reduces our risk for us as well and for you. And then in terms of the markets that we invest in, market expertise is crucial to us. We will only invest and focus on the markets where we know best and we have deep experience. We're only investing in markets that we believe in over the term of the investment horizon, and that's over the long term. And then we focus on asset types and business plans that we have deep expertise in. And then we structure our deals with our investors top of mind. And now I get to dig into our funds. So the first one I'm going to talk about is our preferred credit fund. This fund has the highest preferred return of all of our funds at 9%. The goal here is very similar: make a meaningful impact on America's affordable housing crisis while helping sponsors scale their businesses, create jobs, and build thriving communities. The strategy here is a shorter term strategy to invest in the development, improvement, and preservation of attainable rental housing. We're focusing on short-term loans in this fund, anywhere from 3 to 36 months. And this is helping insulate investors from rising interest rates and inflation while offering significant liquidity to complete or continue their projects. And then the primary investments in this fund are rescue capital. And to be very clear about what we mean by rescue capital, that is not investing in a bad sponsor or a bad deal. That is investing with a great sponsor with significant experience and a very solid deal at a low basis, but one that is typically going to be constrained or face some challenges due to the current interest rate environment. And then distressed opportunities where we can make a direct investment in something that has tremendous upside, but is currently in a challenging position due to the current debt or capital structure. The loans in this fund are primarily subordinate and senior secured loans. And again, they're all backed by rental housing that is designed to be affordable or attainable for working families at that sub 30% of area median income number. In terms of the structure of the fund, 9% preferred return, targeted annual net return of 10 to 11%. Since inception, it's delivered 10.5%. If your distributions were compounded, it'd be about 11. We, as I mentioned earlier, all of our investments, all of our funds are structured very simply with the investor first. So we are a low fee fund manager and operator. The only significant fee that we take is a management fee, and that management fee is subordinate to the preferred return. So in the case of the preferred credit fund, we as the fund manager do not take our management fee until you, the investor, have received a 9% return on your capital. After that, after we take our management fee, all the remaining proceeds or profits from the fund are split 80-20. 80 to you, 20 to us. There are no performance hurdles or waterfalls that dilute your percentage of the returns. The better the fund performs. For investments that grow in size, we give a management fee rebate starting at 50 basis points all the way up to 125 basis points from $1 million up to 25 million invested. We pay all of our distributions monthly, and you get 2 distributions every month in this fund. The first is the 9% preferred return. That's a very consistent, you see the same number basically every month. And then the second is the EDC, or the excess distributable cash, and that also gets distributed every month. Our outlook for this fund is that it's going to perform or be the better performing of our two funds. So I'll talk next about our lending fund, but we have a very positive outlook for this fund going forward and anticipate that it's going to be the highest yielding of our debt funds. The capital in this fund is very liquid. So once you've placed your capital in the preferred credit fund at any time, you can give us your notice to redeem. And then once approved, we will return your capital in a maximum of 90 days. Our target fund size here is 1 billion. It is because it's a debt fund, it is a 1099 tax reporting and has a $200,000 minimum.
Hey, Andrew, I just want to back up and emphasize the 90-day policy that you just mentioned there. That is actually incredible for a real estate fund. Many real estate funds have lock-in periods of 3 years, 5 syndications, are locked in for the lifetime of the investment. Having a 90-day notice for redemption period is really quite extraordinary. And that was actually one of the things that initially piqued my interest in your group.
Yeah, thank you. Thank you. Yes, and I would agree. I've been in this space for some time, reviewed a number of different funds, and the liquidity, both the return structure, the low fees, as well as the liquidity, are really structured in the investor favor.
Okay.
I'm looking at questions here about this. Minimum investment still 200K. Yes, it is. Can you facilitate 1031 investments? No, we cannot, and that's across all of our funds just due to the size and structure. We do have a DST, a deferred sales trust structure that we work with for investors that are looking for some tax deferral options for capital gains, tax issues that may arise from the sale of another investment. How leveraged are your funds? No leverage in this fund. I'll dig into that in a little bit here. What else? The EDC typically in this fund historically has been the delta there between the 9% and the annualized return since inception. So an extra about 1.5% has been the EDC. We're shooting for to outperform that this year. And is there a limit to how much individual investors can withdraw? How about as a group? What happens if everyone exits at the same time? So no limit to how much individual investors can withdraw. The caveat to that is you cannot withdraw below your minimum. So for example, or below the minimum. So for example, if you have a $200,000 investment, you cannot withdraw, say $50,000, that would bring you down to $150,000. You cannot be invested below the investment minimum. But if you have $400,000 invested and you need to withdraw $100,000, that's totally fine. And then what happens if everyone exits at the same time? Never happened. We don't ever anticipate that happening. The fund is very liquid, structured very conservatively. I'll talk more about that and the protections that we have in place for the fund, but we do have provisions in place to maintain the integrity of the fund and protect investor principal. So for some reason, there was a tremendous withdrawal request that we felt like was going to compromise the integrity of the fund, and we do have a provision that allows us to pause liquidations. The interest from this fund, taxed like any other interest, is 1099. The tax benefit for this fund and for all of our funds, because they're private REITs, is the qualified business interest deduction, or the QBI, qualified business income deduction, which reduces the taxable income in the fund by 20%. And then do you take or entertain self-directed IRA funds? Yes, we do. So a significant number of our investors invest in qualified funds or with qualified funds or self-directed IRA funds. And then just some high-level kind of overview about the fund in terms of what you can expect. So typically funds received by the 25th of the month are deployed the 1st of the following month. As I mentioned, that management fee, there's a true preferred return. And so we don't take that management fee until in this fund you receive 9%. Something to note about DLP and really our rules number 1, 2, 5, 10, and 20 is don't lose money. And since inception, across billions in equity invested and significant, $5 billion plus in assets under management over 18 years, we have never lost $1 of investor principal, and we have never missed a preferred return. In terms of other fees, we're very low fee. So we have a clean balance sheet, no junk fees, a small administration fees, some other small fees in the fund, but very low fee compared to other private real estate funds. As I mentioned, monthly preferred return, monthly EDC, and those are paid on the 15th of the month. 90-day redemption notice. And then in terms of the reporting you can expect from DLP, quarterly fund report, quarterly financial statements, an annual audit by a top 10 auditor, Cohen Resnick, quarterly data tape. So you can look at every single loan in the fund and get significant details about it. And then, as I mentioned, all of our reporting is available to you at any time, even before you're invested with us. And then how we mitigate risk in this fund. And so one of the things that our vertical integration allows for or offers is that we can step into finished projects if the need arises. But we are structured, and every single investment we make is structured to mitigate risk. So how do we do that? We only loan to very, very high quality borrowers. So one thing to note about this fund specifically is we're only lending to borrowers, to full-time operators, sponsors that we've already have a relationship with, that we've already made a loan to in our lending fund, which is our first position loan fund. They have proven track records. Typically, the minimum is $250 million portfolio owned or in development. They all have significant equity invested behind our loan. So if you think about the capital stack and where your capital is positioned from the base, being the debt, all the way up to the common equity, this is in a lower position or in a safer position in the capital stack. And behind that, not to mention the equity inherent in the project from the value of the asset, the sponsors themselves or the operators themselves are investing millions of dollars of their own capital behind or subordinate to DLP's capital. So the capital is very well insulated. And then I believe there was a question about delinquencies. Because of the tremendous amount of due diligence and underwriting and risk analysis that our team puts into the deals in this fund, we have no current delinquencies in the fund. Talked a bit about our vertical integration, but just to touch on that again, the different things that we have in house just give us a lot of options and a lot of exposure to the performance of the projects and help us make great decisions about what projects to lend on.
Hey, Andrew, what is the average LTV across your portfolio?
About 55%.
Okay. And I'm also curious, and I don't know if you have a slide on this, and how do you actually source your deals? You have a tremendous amount under management or a tremendous amount of equity invested. How do you find them and qualify them?
The operator sponsors?
Yeah.
Yeah, great question. So, and I would really encourage you all just for educational purposes, but also as you're wanting to get to know more about DLP, to check out some of our webinars. We'll drop a link to those. In fact, I'll drop a link to those in the chat right now. But we had a great. Let's see if I can do that without getting rid of my screen here. I guess not. Well, I'll drop it in towards the end here when we're doing Q&A. But we talked really about our competition, and our competition primarily in our debt funds has been regional and community banks, and lending for those banks has dried up dramatically. And so because DLP has significant capital to lend, because we have familiarity in the markets and with the projects, we're able to lend faster and deliver really at the end of the day better terms than regional and community banks are. And so kind of historically we've had to go out and sort of hunt for operators and sponsors to work with. We've seen a dramatic uptick in operators and sponsors coming to us looking to partner with us either on the equity side or on the debt side. And so for us really now we've had to double our relationship management teams, which are the teams and the folks at DLP that interact with the sponsors and operators that we're lending to just in the last 90 days or so, because we have the most robust loan pipeline we've ever had as an organization. And the primary reason for that is just tightened lending guidelines, banks being probably far too conservative in what they'll lend on, what they'll do loan to cost, and how that burdens sponsors to have to come up with quite honestly just way too much equity in order to get a project done.
Andrew is asking, do you have any experience with deals going south, and how do you handle that?
Yeah, it's a great question. So in this fund, no delinquencies in this fund. I'll talk a little bit in the lending fund. I'll touch on that here shortly when we move over to that fund. But yes, we do, and have a number of things in place to handle that when that does occur. Um, Again, just a little bit more about what it means to have equity behind the loan and how that protects your capital and ours. I'm always equity subordinate to the preferred credit fund on all deals. The fund always gets paid back before the sponsor gets any of their equity back. And in all cases, but one very small deal, there has been multi-million-dollar equity cash invested by the sponsor subordinate to us. And then these are larger loans with lower loan to values that equate to more sponsor equity in them. And then, relative to our debt, and even in a typical first position loan. And then we're only working with larger sponsors with more experience and deeper pockets. And all of our sponsors sign personal guarantees as well.
Andrew, let me know when would be a convenient moment for the Alternative Investing Club to make its announcement and send the survey link out.
Yeah, absolutely. So we created there's a slide at the end about it, but
Okay.
you can do you want to pause and do it now? No, we can hit it
No,
again at
just
the end.
whenever it's convenient for you. I just want to make sure people have time to look at the form before they go.
Oh yeah, absolutely. Um, and then just in terms of oh goodness, we're at 3:40 here. All right, I'll speed through this a little bit more. So in terms of our criteria and the vetting that we do before we make a loan in this fund, these are high demand asset types: single family, multifamily, RV, mobile home parks. In terms of who we're lending to, they have to have a strong track record of acquiring, exiting, or managing undervalued properties. We're only lending primarily in the Southeast, and then really balancing risk in asset classes and geographies where we have experience, several different loan reserves to mitigate risk, and then proceeds being distributed in proportion to borrowers' project completion. So we have significant construction or improvement holdbacks and want to make sure that the project is progressing before we're releasing capital. And then how this fund has performed: Q4 2023 was 11. So since as of Q4 2023, 11, just over 11% with distributions reinvested. And then just some of the Q4 highlights for the performance of the fund. Annualized returns and monthly returns since inception. And then just some snapshots here about where we're lending: Florida being the top state, the types of communities that we're lending on, and then the average borrower. So I mentioned that borrowers are putting in a significant amount of equity behind us. The average equity that the borrower has behind us or subordinate to us is just shy of 7.5 million, which is a very nice insurance policy. And then just a fun little stat: if you invested 200,000, what that would be. Again, highest preferred return of all of our funds, highest quality borrowers with the most equity subordinate to DLP or invested behind DLP. And then just, what are these loans actually, who we're actually lending to? What do these loans actually look like? This is a case study of an RV portfolio that we did a preferred credit loan on. Just a high value RV portfolio in the Gulf Coast of Alabama. Tremendous demand, a very strong longtime borrower that we had a pre-existing relationship with a stellar reputation, track record, highly liquid. And already basically when we made the loan, there's already a plan in execution in place to pay it off. And then just some progress photos from the actual project. And now our lending fund. So this is our oldest fund. This fund has been in operation for 10 years, since 2014, has paid out over 134 million in distributions to investors since inception. And the goal, again, to impact the affordable housing crisis. The strategy: shorter term loans, 6 to 24 months, to, again, investing in attainable rental housing, producing attractive risk-adjusted returns for our investors. And these are senior first position loans on build to rent, as well as single family and multifamily development and value add projects. The fundamentals of the fund, many of these things you'll see are very similar to the preferred credit fund. The primary distinction here is an 8% preferred return instead of a 9% preferred return. Slightly lower targeted return at 9 to 10%. Since inception, if distributions are reinvested, would deliver a 13.26% annualized return. Everything else being the same: management fee rebates, etc. Typical deployment in this fund, 10 to 30 days. Management fee the same, distributions the same, preferred return EDC, the same liquidity, same fee structure, same reporting that you can expect. The difference is the lending fund does monthly, generates monthly reports and monthly financial statements. And then just a few notes about it. Really has seen significant and sustained demand since we started it. We anticipate that we will have roughly 1.5 billion in loans in the portfolio by the end of 2024. We see a tremendous amount of demand for this product from qualified, highly capable, competent sponsors and operators. And every single loan in this fund is in a first position or senior secured position, along with a personal guarantee from the borrower. Typical borrower in this fund: experienced investor, clear business plan, significant team, and then that we're targeting at least 85% of all investments made are going to be backed by assets that are affordable for the local workforce, typically single and multifamily homes and communities. And then the fund performance, again, since inception, just over 13.25%. As of 2024, loans under management, roughly 1.5 million. Average loan to value, somebody asked about the LTV in the fund, 56% roughly. 78% loan to cost, 3.7 million distributed to investors. And the difference there between the AUM and the loans under management are the construction holdbacks. So that's why you see that difference between those two numbers there. In terms of the benefits of the fund, significant liquidity, 100% of its income distributed monthly, all senior secured mortgages, 1099 tax reporting, and again, no lockout period. And then just another case study of a really solid project that we put together here. This was a newly acquired land by a developer, getting it ready to build 200 lots. They needed a loan to quickly close and do the civil work in order to get the lots ready for development. And shortly after we provided the loan and they got to work, the sponsor already has an LOI in place to sell all 215 lots to a local home builder. So again, a very conservative loan at a low basis in a very strong market. And I want to touch on the question about the don't have a position senior to the fund. In the lending fund, no. In the preferred equity or in the preferred credit fund, yes, because those are by nature, at least a portion of them are second position loans. In terms of deals going south, yeah, so in our lending fund, traditionally what we see is somewhere between a 4 to 6% delinquency rate. And our practice since inception, because DLP is very well capitalized and our principals, our CEO and leadership are also very well capitalized, is that every single loan that we make, we underwrite it in a way that we don't anticipate it's going to have any issues. So very, very conservative and consistent in our underwriting standards. But we also, every loan that we make, every property that we're investing in that way, we're totally fine. If the loan didn't perform, we'd be more than happy to own that property in our portfolio. So our practice since inception has been when a loan goes delinquent and it is clear that the sponsor is not going to be able to recover and make those payments and bring it back current, we will actually buy the loan out of the portfolio and operate that property. And so we have a position, we have a structure in place that allows us to do that. Historically, that's been about 1% of the loans. And so most we're able to work with the sponsor to get them back on track. But if there is a loan that just really is not salvageable by the sponsor, then we are always more than happy to buy those loans back directly from them. Is the 9% return after expenses? Yes, so all returns are net of fees and expenses in the fund. The EDC comes from excess cash distributed by the fund. And so at the end of every month, both in the lending fund and the preferred credit fund, excess cash generated from fees, from loan payments from the sponsors, whatever it may be, but those are the primary sources of revenue there. Those all that excess cash that is not needed for ongoing liquidity or operations of the fund is distributed to investors. Best and worst deal. Oh yeah, go ahead.
Oh, I was going to say, would this be a good time to jump in with what the club is doing?
Yeah, absolutely.
Okay.
Yeah. We'll move it to the end.
Let me drop the survey into the chat. Yeah, I would highly appreciate it if everybody would go there. And I'm going to share my screen really quickly. So one of the passions that this club has had over the past 5 years is just bringing outstanding educational content to investors, first of all at Intel and then publicly through the Alternative Investing Club. And we're looking also at creating ways of adding value to the group here, as well as helping to sustain the club. And so what I would love to get your feedback on is a alternative investing club fund that would allow people in the club to group together in order to meet the minimum investments, or more than the minimum investments, of high quality institutional groups like DLP. And I know that in your feedback to me, you've said that you want to see more deals presented in the club, not just purely educational content, but actual opportunities presented. Quite a few of you have commented to me that it's great that there's educational information, but you have to go to other groups in order to actually find deals. And so the idea here would be to make good on that request and actually bring people into the club who are high quality real estate investment firms. So the idea of the fund would be to create a alternative investing club fund with a low minimum and low fees that would allow members to group together and participate in funds that would normally be out of reach or perhaps difficult to reach for single individual investors. The fund's investments would be entirely driven by the club here, the community here. So, and what that means is that we would continue to bring in educational speakers, and you, of course, are always welcome to go reach out to them directly and invest with them directly. But if you wanted to, you could also invest through the club fund, which would have lower minimums. And that would allow you to reach these high quality institutional investments. If enough people in a given meeting decide that they want to invest in a particular group that has come in and presented, and we meet the minimum amount for that, then the funds that are allocated from that meeting would go into that investment. And if not, of course, you could either have your funds back, or you could choose to place it in the fund, which will be growing in diversification as more and more speakers speak. So the goal of this is really to come in with large institutional funds that have ultra high quality track records of performing on a regular basis, either on a monthly or quarterly basis, and to build a fund based on the demands of this group and directed by this group with increased diversification over time. And then, of course, we would actually regularly report on the fund here in the club. So it might be a 5-minute intro at the beginning of a club, or probably at the beginning, where we just present, hey, here's where the fund is. Here are the distributions, here's the size, etc. So our reporting would actually be, of course, if you're an investor, you would get a report, but the reporting would also be made public here in the club. So if you're interested, or if you're not interested, I want to hear that too. Please go to this QR code, this form link, and give me your feedback. I have a number of questions there around how to structure the fund and to what extent this community is interested in a fund like that. So please take the time to look at that and to send me your feedback. Also, if you have any feedback about anything else related to the Alternative Investing Club, I am attempting to roll out services that would continue to benefit this community. And so we have the YouTube service that just came out, and we have future services that we're looking at putting together as well. So I would love for this to be a community-driven process. Back to you, Andrew.
Thank you. Looks like you're getting some feedback about the survey not working potentially. I'm not sure.
The link doesn't work.
It worked for me, at least opened up.
Should
Okay.
just be a Google form.
All right. I'm just reading the chats.
Okay.
It seems like the email portion is not accepting non-Intel.
Oh, yes. I have purposely blocked Intel email addresses. Please don't use those.
No, I think it's the other way, but I think the opposite's happening because I'm putting a non-Intel email.
Oh, it's
and-
only accepting Intel? Give me 1 second. I will fix that while Andrew talks.
Hey, Daniel, it works for me and I'm using non-Intel, so.
Okay.
I'm using non-Intel and it's not working for me when I try to submit.
Yeah, it's not working either.
I'm looking here. Let's, I don't know if this is going to change the form, but it was set to only accept Intel email addresses. I meant for it to only, to actually accept anything but Intel email addresses. Try it now. I think it is working now. And if it isn't, I may have to drop a new link here. Here's the link that it has after I change that.
Seems to work now. Thanks, Daniel.
All right. Apologies for that. Back to you, Andrew.
Okay. Well, I'm just wrapping up here. I know we are approaching time, so
Yes, 6 minutes left.
we just get excited talking about real estate and time flies. So I will just on a couple notes about DLP and what we do and what we really look to create for our investors is obviously tremendous amount of reporting, as I touched on. And if any of you would like access, there's going to be a QR code here that you can book a quick time with me on my calendar. I can get to know you a bit and then share everything, all of our resources accessible to you. I dropped a link to the 20, which is where we put all of our educational resources. So we are deeply committed to transparency and communication with our investors about exactly how our funds are performing, what our market outlook is. And if you can go back in there and review any of those webinars, Don Winter, our CEO, is on basically every single one. I'm doing a deep dive review of every single fund's performance on a quarterly basis, in addition to webinars just about life and about building legacy and family and health. And we really seek to serve our investors beyond just helping them grow their wealth. So these are some of the upcoming webinars that we have. Some of the upcoming events that we have. And so we love to meet our investors in person, and we try to facilitate as many in-person gatherings to do that. So we'd be happy to interact with you or host you at any one of these events that we have coming up. And then, as Daniel mentioned, if you want to invest in the Alternative Investing Club Fund, very excited at the potential of partnering with him and with y'all to work together with you. And if you'd like to get to know DLP more and be invested at that 200K or above minimum in any one of our funds, you can scan that QR code right there, visit that link, and that'll link you to my calendar for just a quick 15-minute call for us to get to know each other and share some resources with you. So I know we're coming up on time here. Let's see if there's any last-minute questions I can answer.
There was a question. Go ahead.
Yeah, there was a question about the bank, and Jack Aldridge, who is one of my tremendous colleagues. And the question was, we've recently acquired a couple of banks as an organization, and that was basically asking if we're kind of commingling funds or if that bank operates as a lender to our funds. And the answer is no. Unequivocally, no. They have nothing to do with our funds or our lending, separate business completely. We will refer borrowers to the bank, but that's the extent of the relationship there. And any other final questions for me before we jump off here? Or Daniel, do you want to address any of these that came up? He wants to know, would you direct the capital? And then assuming they invest via the SPV, what are the additional costs for legal CPA? Do you want to touch on fees or anything like that, or talk about it later?
Sure. The club fees would be, or the goal there would be keeping them low. But obviously we're going to have some fees in order to cover tax preparation, which is usually a larger cost in running a fund like this, CPA, things like that. So there's always, whenever there's a fund available, there has to be some, management of that fund. So the goal would be to keep them low. But of course, there's tax prep, which is usually what a lot of the fee goes to. Any other
Excellent.
question? All right. Well, with that, could everybody take themselves off mute and thank Andrew for coming in and presenting to us today?
Thanks, Andrew.
Thank you, Andrew.
Thanks, Andrew.
Thanks,
Thank you,
Andrew.
Thank you, Andrew.
Thank you all. Thanks for taking your Friday. Really enjoyed it. Please reach out. Daniel, thank you for having me on again. Look forward to working with you and hope you all have a tremendous weekend.
Thank you.
Thanks, Andrew.
Yeah.